Welcome back to Money Movers. Take a look at shares of Goldman Sachs just going positive again on the flat line, despite reporting beats on the top and bottom lines for Q2. Record equity trading revenues accounting for a lot of that beat, coming in $840 million ahead of the street forecast. Joining us here at Post 9 exclusively on CNBC is Goldman Sachs Chairman and CEO David Solomon. Welcome. Nice to have you.
Thank you, guys. Good to be with both of you.
Not moving much, but a 22% jump in profits. You must be pretty happy. What are you seeing?
I'm happy with the firm's performance. We had a solid quarter, and it's actually interesting if you think back to April 1st and think about the journey of what's occurred over the course of this quarter. There's been a lot. Our team's been focused on serving our clients. Clients were active. Activity levels are picking up, and I would say as we got through the quarter, the level of confidence in the client community has actually increased. I'd still say there are pockets of uncertainty, and there are certainly businesses and industries that may still be more affected by trade policy than others. But the level of confidence as we went through the quarter after a pretty bumpy start, has increased, and we saw our clients pretty active, and that activity continues to gain momentum here in the second quarter.
I mean, a few standouts. The equity trading is one that a lot of people are talking about. That was big. The volatility around the tariffs. So is that sustainable?
The equity trading business is driven by broad activity. And, the broad activity feels sustainable as, market grows, market cap grows, economy grows. Our financing business is super important to our equity business. We are the leading equity financing shop, and that plays a big role in the overall equity beat. And so, clients were active. I wouldn't say that we'll see the volatility we saw in the early part of the quarter in the next part of the quarter. But clients are active. M&A is picking up. IPOs are picking up. That's actually good for the equity trading business, too.
Yeah, I mean, there was outperformance there from you. I guess I was looking at the Morgan Stanley advisory fees. I mean, you had a very strong quarter, even though, yes, M&A is picking up, but it feels like it was supposed to be more robust at this point.
There's been a narrative, and I've watched and I've listened to it, that M&A wasn't picking up during the course of this year. Announced M&A is up 30% year over year. And we have the leading M&A franchise, and we're benefiting significantly from that. I think you saw in this quarter larger outperformance in our M&A accruals than you'll see in most quarters. But our franchise is in good shape. Clients come to Goldman Sachs for the most significant things. And I think one of the structural things that's changed is CEOs believe we're at a moment in time when you can do big strategic consolidation, that it actually can get through the regulatory process. And so they've gotten much more engaged in those dialogues, and we're seeing that. And so I expect a pretty robust M&A environment in the second half of the year, into early 2026.
Oh, that's interesting, because we kept pounding you every time you were on, and you kept saying it's
coming.
Yes, but you think it begins to bloom from here?
Well, I think it bloomed this quarter.
Yes.
I mean, you look at our M&A accruals, it's bloomed this quarter, and there's good momentum to it. But when I look at what I'd say, the soft data, the anecdotal data, how many CEOs are calling and saying, hey, we'd like to look at this? How many projects are getting opened up? How many conflicts are we clearing around significant M&A activity? I'd say there's been a meaningful pickup in that. We highlighted that on our call when we referred to our backlog and the movement in our backlog based on advisory activity. And I'd also say the sponsor community is finally kind of getting off the dime. And I think you're going to see a pickup. It is a finally. I've been really wrong on that. That has been a lot slower than I expected, but I feel like that's coming too. So I think the tailwinds are constructive on that, unless we have a really disruptive policy environment. I think the market is absorbing and looking forward. And I think one of the things that's sustaining kind of the tailwinds in market activity, AI is a productivity influencer in business broadly as AI is deployed in the enterprise. I think it's having a meaningful impact on earnings growth, forward earnings growth, and a perception of efficiency opportunities and investment opportunities for business. And I think that's something that's playing a big role in equity prices right now.
Across industries.
Across industries. This is something every CEO is talking about. How do we use this technology to really automate processes, change processes? And it's not just take out costs and create efficiency. It's also free up resources to invest in growing our business. And that's a very economic growth, pro-growth thing.
I was going to ask you, sorry, the CapEx boom, I mean, that has fueled the equity market. How much a bank like yours participates in that through financing and lending, and whether that's a big part of the activity?
It's a good point, Sarah. we highlighted in the call this morning that all this infrastructure around power and AI requires a huge amount of financing, and we will participate in that and benefit from that. And so that's another tailwind that I think you'll see over the course of the next 6 to 12 months.
This, in the last couple of months, there have been some internal Goldman podcasts where leadership has talked about maybe reining in risk. Where do you think, how does that dial move right now?
So we have a very strong risk management culture, and I think one of our responsibilities, given the nature of our business, is to always be thinking about and worrying about things that probably have a small probability of happening. And so when markets run, when you get into an environment that feels, very forward, and I think we've moved into that kind of environment at the moment, one of the things we spend a lot of time talking about in the firm is what could go wrong. How are we prepared for it? If the market was down, if we woke up in November and the market was down 10%, why? What caused it? And how would that impact or filter through, our risk positions? So we spend a lot of time on that, and I like hearing our people talking about risk management at a time like this, even though I think in the distribution of outcomes, we're probably going to have, a pretty constructive environment for our business, through the rest of the year.
Well, you said that through M&A. I'm curious if you're as optimistic on IPO activity as well?
Picked up in the second quarter. We did a bunch of IPOs that were significant in the second quarter. I'd call out Chime, eToro, Circle. These all traded well, in the secondary market. There's a pretty good pent-up backlog of IPO activity, and I think you're going to see more of it in the third and fourth quarter, particularly if this equity market sustains.
So what kind of, economic growth picture are you looking at for second half and into next year?
It feels to me, if we were talking, a month and a half ago, I would have told you that the policy uncertainty had slowed the trajectory of growth, but I still kind of expected 1 to 1.5% growth this year. As I'm talking to CEOs and listening carefully to what's going on in their businesses, I think we're getting a little bit of an acceleration. I had a group of CEOs and investors in my apartment for dinner on Monday night, and one that runs a very consumer-centric business made the statement that in April, he saw consumers kind of pause for a few weeks, but they've kind of been back to the races. Company that does discretionary kind of stuff that I think is a pretty good window into consumers. So I feel a little bit of a reacceleration. I'm a little bit more constructive on the growth trajectory based on where we are at a moment. And look, some of this is confidence. It's hard to say that confidence is not higher on July 15th than it was on May 15th. And if confidence is higher, you're going to see that in behavior.
Do you think is that getting reflected in the yield curve?
I think it's getting a little bit reflected in the yield curve, but I think there are bigger macro issues, affecting the yield curve and the dollar, particularly as we think about, and this is something I remain concerned about, the structure and the trajectory of our debt and our ability to control our fiscal spending. And so, I think this is an issue in the next 5 years. It's going to get a lot of attention. It has the potential to create significant speed bumps, but the more likely scenario is we continue to grow the debt stack, and that puts pressure on term treasuries and also crowds out other investment and therefore could be a counterbalance to growth. And so I don't think it's a big 2025 issue, but I definitely think it's something we should be focused on, something I'm concerned about. And it's something that I think is going to get a lot of attention as we continue to spend and grow our deficit, which is the direction of travel at this point.
Speaking of rates, you've been, for last year or so at least, higher for longer camp. And Fed, for the better part of the year, has been on hold. So that's been right. What do you think happens next?
Well, the trajectory here, you're asking what happens next. You're talking about in 2025.
You think we'll get a few cuts?
I think there's a reasonable chance we get a cut or two, but not certain. And, I think the market is absorbing the trade policy. But on the call, I specifically said, and I think this is the best way to frame it, even if we have base tariffs, some special industry tariffs, we get a bunch of these trade deals. The trade deals are yet to materialize significantly. And we don't actually know the impact, of 10% base tariffs and these specialized tariffs on economic growth. We have to watch closely. So it seems like inflation is on the right trajectory. I think we could get a cut or two, given where term rates are at the moment. But we'll have to see.
Yeah, still uncertain. Do you worry about Fed independence in this environment where there's a lot of political pressure on Fed Chair Powell?
I think central bank independence, not just here in the United States, but around the world, has served us incredibly well. I think it's important. I think my comments here on Fed independence are with respect to monetary policy. I think regulation and supervision are different. But with respect to monetary policy, I think central bank independence, Fed independence is very important, and it's something we should fight to preserve.
How do you feel about international right now? Have you been impressed with Europe's turn? Do you think some of those shifts are long-lasting, either on their spending or fiscal discipline, debt breaks?
The direction of travel is definitely positive. I think a more fiscally stimulative Europe, a Europe that's investing more in its defense and in its industry and infrastructure, is good for growth in the world. The question is, and I don't know if you saw, but we had our board in Paris at the end of June, and I put an op-ed, into one of the local publications in Paris. Can the nations of the European Union get together and actually execute on the things they need to do to bring down barriers, allow investment, act as a constructive economic union as opposed to, a collection of, individual provincial states? And, I think the jury's out on that, but the opportunity set is better. I see more institutional capital interested, but still questions on whether or not they can execute and they can really move the ball.
Yeah, they got to follow the Draghi report. You mentioned regulation and supervision for the Fed. That's another hot topic, and it's why your stock and some of the financial stocks have been big winners so far. What are you expecting as far as actual deregulation, and how would it impact your business?
Yeah, I'll touch on that, but I can't resist, since you said it, that our stock has been a big winner because of deregulation. There's no question the regulatory environment. The regulatory environment's a factor, but one of the things we're really proud of is that when we look over the last 7 or 8 years, we have significantly grown the firm and executed on a strategy to grow the firm, which has significantly grown the revenues and the earnings of the firm, which therefore has grown the market cap of the firm. Now, I think the multiples that all the large financials are getting are improved, and the reason that they're improved, there's still a big discount to the market multiple, but the reason they're improved, one of the reasons they're improved, is because the regulatory environment is improving, and it's improving after a very harsh swing in the other direction over the last 4 years. I think there are 4 big buckets of focus around regulatory policy that are going to get a lot of attention in the next 6 months. 3 of them are really around capital, and this includes ESLR, the leverage ratio, which, there's a proposal that's moving forward, which is quite constructive in allowing capital to be recycled into the system to support the system. The second is GSIB, and GSIB was supposed to be calibrated for growth in the economy, growth in markets, but it hasn't been. And if you look at the growth in large bank capital over the last 7, 8 years, GSIB has been a very significant piece of that growth. And so how do we recalibrate GSIB to account for growth is a second big bucket that can create capital relief. And the third is the CCAR process, the stress testing process, and creating a better process with more transparency around it. I think the direction of travel on all 3 of these things are constructive. And I think the big thing that's getting asked about, which is appropriate, is 15 years after Dodd-Frank. We've learned a lot. We want the right answers. We want a transparent, clear capital regime where people can plan, investors have transparency, and they understand, so that we can have the most efficient capital deployment into markets to drive economic growth. And I think there's a good chance we make progress on that. The 4th bucket is regulation and supervision, kind of the supervisory process, which has been quite burdensome without a real focus on safety and soundness. And I think that pendulum is going to swing back. And what that does is it frees up resources to invest in growth, and I think that's also constructive. So pretty constructive environment, more to see over the next 6 to 12 months, but I think that's one of the things that's moving the sector pretty meaningfully.
Finally, on headcount, does the evolution of AI alter that trajectory?
It has an impact on headcount growth to some degree, but one of the things we're excited about, I talked about on the call, we're working with a company called Cognition Labs that has something called Devon, which is an agentic AI program that really, think about it as we can have an engineer overseeing software coding through this agentic program. And, a way to think about it, I saw it demonstrated in a way where in a matter of less than an hour, it basically produced a website that it would take 10 engineers, 3 days to produce. And so the leverage in your ability to kind of reinvest those resources into other more productive activities or additionally productive activities and growth is quite compelling. So it's not as simple as people out, cost out. It's about being able to create more automation, more efficiency, more productivity, and therefore free up capacity to invest in things that grow your business. I think this is something that all CEOs and all industries are talking about, and we're super focused on.
Yeah, I know it's one of the reasons you're optimistic. While we have you, I do have to ask you about an issue closer to home, which is the New York mayoral race. Goldman Sachs is a stalwart here in New York. You are a lifelong New Yorker. I'm just curious what you're thinking and how you're planning having potentially a socialist mayor in the heart of capitalism in the world, which is New York City, as defined by companies like yours at Goldman Sachs.
Well, there are a couple of things. I'd say first, we're in an election, and, this will develop, but there's certainly a possibility that Mondami, won the primary, is elected mayor. And as you highlight, Sarah, I mean, this is, I am a New Yorker, and this is deeply personal to me. I'm a three-generation New Yorker, and I think New York is the greatest city in the world. And, I care deeply about, the trajectory of New York. For New York to thrive over time, there are a bunch of things that are important. First and foremost, it needs to be safe. It needs to be clean. People need to feel safe in the city. Housing needs to be affordable in this city. Education needs to be stronger in the city. And the business community needs to be present here and growing, in this community. One of the things that I don't think gets enough attention, if you look at, our industry was largely based here 25 years ago, and there's been a lot of job growth in our industry, but not in New York. That's been a long-term trend for our industry to have job growth outside New York. So I'm focused on policy. I think policy matters. Whoever is elected mayor of New York, we're going to have to engage with and work with, and we'll be very focused on advocating, for policies that we think will make a difference. And, on substantive policy, I just point out, one thing, for example. There is no question that we have a housing shortage and we need more affordable housing in New York. The concept of freezing rents or rent controls, this is not new. This has been around for 100 years. And you can go back over 100 years and look at lots of times when that policy has been put in place in New York. And every single time, the result was less affordable housing, less good housing, less available housing. You can't find an academic study that suggests that this is a good policy. And so these policy decisions matter. Now, what can we do? Well, I think there can be more public-private partnerships. I'll give you an example of a small one. Just yesterday, Asahi Pompey, who works for us, was out in East Brooklyn because we're making an investment in 2,000 affordable housing units, out in Brooklyn. And so get the private sector to partner and create incentives to build more affordable housing. To me, much better policy, because you can go back to the 1920s, you can go to the 1960s, you can go look at times when there's been rent freezes, rent control, and it basically limits affordable housing, it narrows investment in new housing, and it makes housing that's not in the control area more expensive. And so I don't think it's good policy.
No, I don't think that's what this guy has in mind. The public-private partnership.
Well, we're going to have to work with whoever is mayor, and we're going to try to advocate, for the best things for New York. And New York's a great city. It's a big city. But, this stuff matters. And you can look at other cities, like San Francisco, where policy changes have led to difficulties. And so it's going to be important, for us to have a voice in this.
As I'm sure you will. Hope you'll stick around for one more minute.
Sure.
We want to get your reaction to some breaking news that we're getting out of Washington and our Megan Casella. Hey, Megan.
Hey, Carl, we can report now that the White House says the president is considering firing Federal Reserve Chairman Jerome Powell. That's according to a senior White House official, saying the president asked lawmakers meeting in the Oval Office late yesterday how they felt about firing the Fed chair. The lawmakers that were in the room, 12 Republicans, expressed their approval for firing the Fed chair, and the president then indicated that he is likely to do that soon. Now, I will emphasize, guys, that there is no timing attached to this. This is still in flux. It's no No decisions have been made that are final, but that is the latest we know that the president now says he's indicated he's likely to do this sometime potentially in the near future. This is a big escalation here. Of course, we'll set up a big legal battle for one if he does go through with it. But it also comes after just yesterday he was asked by reporters whether he was considering taking this step, whether he thought this whole dust up over Powell and the renovations of the Federal Reserve building were a fireable offense. At the time, he said, I think it sort of is, but he did not go so far as to say he was considering firing him. Now, again, according to a senior White House official, they say the president has indicated he is likely to fire Powell sometime soon. Guys.
Megyn, thank you for that. Stocks hit a bit of an air pocket here. Dow's down 150 in a hurry. Long bond goes to 505. Do you have a reaction, David?
I'm watching the news come off the tape that there's a rumor that he might fire Jerome Powell. I don't have the facts. I can't comment on it. So I don't really have anything to say at the moment.
But it would be a bad thing if the president were to try to fire the Fed chair.
I think we talked before about Fed independence. I think Fed independence, particularly in monetary policy, is super important. You know, I noticed she was commenting on this discussion about the building. I don't have any that I haven't followed closely. I don't have information on that. But stability in the Fed seat, I think, is important, particularly around monetary policy.
All right. Well, David, thank you very much for the time today on earnings and everything else.
My pleasure.
We appreciate it. A lot going on.
Much.
David Solomon, Chair and CEO of Goldman Sachs.